Chris Minnucci, instead of buy and hold, you suggest something called black belt investing. Can you tell me about it? It sounds exciting.
Okay, Greg. It's basically my new name for an old idea. And it's long been known that if you use investments with low correlation to the broad stock market, you can reduce your own portfolio's volatility. The little twist that I add to that is I focus on highly volatile investments to do that. And the reason I call it black belt investing is it's similar in concept to judo. In judo, a black belt can take a larger, stronger opponent and use that opponent's size and weight advantages to throw them off balance. Similarly, with black belt investing, what you're doing is taking the one characteristic of the stock market that makes it so frightening to so many people, namely its volatility, and you're using that to your advantage to actually reduce your own volatility.
So you're adding volatility to reduce overall volatility. Can you tell me how you're doing that? So if I gave you $1 million right now, how would you manage it the black belt way?
What I would do is I would use a little bit of that $1 million, not a lot, to buy gold mining stocks, precious metal equities, or PME. PME has low correlation with the broad stock market, so you get a potential reduction in your volatility. At the same time, because PME is extremely volatile compared with the S&P 500, for example, you're actually get opportunities to buy it low and sell it high every time you rebalance your portfolio. So potentially you get lower volatility with better returns.
And a lot of people add bonds to their portfolio to lower the volatility. You don't mind that, but you like emerging market bonds. Why is that?
Emerging market bonds, it's similar in concept. They are volatile compared with most other categories of bonds except maybe high yield bonds. But again, low correlation with the broad stock market, so you get some reduction in volatility because they often tend to go up when the market's going down. But at the same time, you're earning returns that are better than what you can get from bonds in general. And I don't, I don't have anything against treasuries and corporate and so forth. They have a place in your portfolio too.
And you like index funds, right?
Index funds, yes. There's been so many studies that have been done that show that, the one thing that correlates with better returns is lower costs. The more you get to keep, the better you do.
And then finally, how do you not outlive your money in retirement? This is something that's also a big part of your book.
Yes. What you have to do is recognize that there are two ways that you can run out of money in retirement. A lot of people focus on volatility. That's only one of the ways. The other way is if you earn not enough returns to keep up with inflation. And so you have to find a balance between those two aspects. And black belt investing is one of the ways to do that, but the book discusses a lot of other ways to do that as well.
All right, thanks for coming in, Chris.
Thank you, Greg.
Thank you for watching The Street.